Amongst multiple categories or kinds of equity mutual funds, multi-cap funds are emerging as an important alternative or investment option for long-term investors. Giving a taste of entire equity market gamut, multi-cap funds are standing tall on returns in long-term and across categories. Let's find out why most experts are recommending it to be part of your portfolio.
Multi-cap funds is a culmination of investing in different equity categories, from large cap stocks to mid-cap and even small cap stocks, thereby being able to make most of the opportunities available across categories. In fact, experts believe that the composition of multi-cap funds helps it to manage volatility better and offer enhanced returns.
Multi-cap fund is a fund category which invests in equity shares of various companies which are falling across the market cap cycle. If you see, there are few large cap companies which are very large in size and their equity outstanding equity market capitalization is very high. There are some small cap companies whose market capitalization is pretty low, and there are some mid cap companies. There are funds which are categorical in terms of investment, where they invest either in a large cap or a mid cap or a small cap. But in the multi-cap category, the fund manager has got the flexibility to invest in either of the three categories depending on his choice of the company, as well as if he is liking a particular stock, he doesn't bother to check whether it is falling in any of these categories. So this brings to the table one big benefit, that the investor is not limited to any particular kind of large cap or mid cap or small cap bias. The advantages of this kind of investment is that there has been some correlation between large cap, mid cap and small cap, and the positive side and negative side, and many times there is no correlation. There are opposite correlation or inverse correlation, where sometimes mid caps and small caps move up while the large caps might be correcting, or vice versa. So this gives kind of an hedge to the fund manager, where he can invest in multi-cap funds and hedge against the fall of either of the capitalization categories.
With much focus being laid on returns, let's see how much multi-cap funds or flexi-cap funds have performed. In the last 10 years, multi-cap funds on an average have given returns of 17%. In last 5 years, 13.3% returns, 25.3% returns in last 3 years, and 30.2% returns in the last 1 year, beating benchmarks across all periods and even large cap fund returns.
Multi-cap funds actually get their edge from the way they are managed, so they are diversified across market segments. So irrespective of the kind of stock that is doing well, a multi-cap fund will have exposure to those stocks. Plus, a good fund manager will, allocate or decide upon the market capitalization based on his expertise, so he can tweak in allocations across market segments and ensure that the fund delivers good performance over the long term.
In a 3-year period, if you see multi-caps, they will have a better advantage of outperforming the market, because they might take exposure to a small cap stock or a mid cap stock which will deliver superior returns compared to a large cap fund. Mostly large cap stocks are well researched and a lot of information is already available. So the price appreciation is not very high there. Compared to that, if you look at a mid cap or a small cap, they just give a kicker to the portfolio, which helps in alpha generation in the portfolio. There is a higher return generated primarily because of that. So I would definitely recommend multi-cap funds, diversified multi-cap funds over diversified large cap funds.
Many believe that for investors who do not review their portfolio regularly, multi-cap funds which balances exposure across different market caps may come handy.
One of the major benefits that these funds offer is the diversification, as we discussed earlier. The diversification across market segments. Plus it gives the leeway to the manager to move across market segment depending on the investment opportunities available in those segments. If you ask an investor to do the same thing at his end, it will be very challenging because of various skill set that is required to do that job. I think these funds offer investors a very good opportunity so that they can benefit from the investment opportunity arising across market segment, which a focused large cap or a focused small and mid cap fund may not be able to capture that effectively.
So how much of one's portfolio should be exposed to multi-caps, and are there more risks involved in investing in multi-cap funds?
Frankly speaking, the one-size-fits-all approach doesn't work while investing. So if an investor has to invest in equity funds, he has to make decisions based on certain factors like his risk profile, his investment objective, and investment horizon. So that is one of the risks which is there. So the manager risk is definitely one of the major risks that I see in these kind of funds, where you have to have a really good and competent manager to do that.
And now comes the aspect of choosing from different multi-cap funds. What should be the criteria one needs to look into?
The most important criterion are: 1, the investment manager and his investment team; 2, the robustness of the investment process; and 3, the pedigree of the fund house. Beyond that, I also feel that the investor should be looking at the expense ratio that are charged by these funds, and also the past performance. And within past performance, investors should focus more on the risk-adjusted return over a longer time frame.
As experts point out, investors cannot put all their eggs in one basket. While multi-cap funds reflect the same in their composition, they themselves cannot be the only investment alternative for investors, even if it could be an important element that can be a part of your portfolio.
It's time now to slip into another short break, and on the other side, Smart Money knocks your door to help you plan your investment. Don't go anywhere.
To get expert opinions on your finances, you can send us your queries at smartmoney@btvin.com. You can also call us on 022 4098 7098. You can also send us an SMS. Just type SM, give a space, write your query and send it to 977 327 0010.
Well, Smart Money is at home, and we are at the beautiful home of Abhishek and his beautiful wife Ankita, and here to help them plan their finances, and we have our very own certified financial planner Surya Bhatia with us to help them, the Chaudhrys, in their financial plan. Well, thank you so much for allowing us to be part of your journey, of your financial plan, and to be at your home.
Thank you for coming. Thank you for coming. It will be a great help.
So tell us about yourself. What do you do, both of you? And do you firstly sit down and plan for your finances together?
Yes, we do plan. In fact, we've been thinking a lot about future goals and how to plan financially about that, and I think it's then that we sort of decided that we need some help from outside maybe to manage our finances.
Yeah, I was more carefree. I mean, she's been the one who's been pushing me that we should be more planned in our finances and all. So that's how it has been. So we sit down and discuss quite a lot. More so in the last some time when we decided that we should write to you guys so that we get some professional help in planning. I work as a freelance consultant, and I'm more into consulting and planning to start my own business in some time. So that's about me.
I am currently doing my PhD in public health. And I used to do some freelance work in between, but right now I'm only concentrating on finishing my PhD because I have to submit my thesis next year.
What are your goals?
Yeah, about our goals, one is at some point we definitely want to have our own house. This is a rented place, so we want to have our own house at some point. Again, the down payments and all for that scares us quite a bit. So that is one definite goal, to accumulate the down payment for.
By when do you want to start your, look at buying your house?
Yeah, what we would want to is the earlier the better.
All right.
But realistically, we are probably looking at a 10-year. Should probably want it earlier.
I would say maybe 5 years, because I also think that you have the loan to pay for X number of years, and I don't want it to stretch forever.
And you have dependents, you have your parents.
We have our parents, though they're not really dependents as such, because my dad just retired last year. So he has his pension, they have their own accumulated corpus and all they have.
What is your biggest worry when you think about money or your finances or something? Because you already look in the financial field, but in terms of, building your own finance, building your own life, what is the biggest concern or worry that you have together?
See, currently we are quite happy the way we are, but when we think of future goals like house, I think house is for me a major, is a big one. Okay, then we are planning kids maybe soon, maybe in a couple of years or so. So then that education and everything. But I think
will come into picture.
Yeah. But I think right now, if we think of it, I think for me it's house basically. I think it's something that will require the maximum amount of money from our side.
Most important thing, and which I think Surya will agree with me, and something that we at Smart Money always emphasize on, is a fact that I noticed in your portfolio is that you acknowledge the fact that there is no health insurance, and that's something that is also a priority list in the immediate term.
Yes, immediate term, the first priority is getting health insurance. That's the first priority.
I think within the next couple of months we'll have one, so we are already working towards that end.
Should we expedite that actually and try to get the policy as early as possible?
Yeah.
Whatever reasons may be stopping you not to have it right now, I think you should explore all the best opportunities and options available and try to zero down on the policy. And if you deem fit, you can even think of covering your parents also. If your father or mother are not being covered by your, let's say, your father's old organization, if it is not, please try to make sure that they also get covered. There are opportunities available now which you can get senior citizens also covered, both by the private health players as well as the public health players. So evaluate all the options. There are a few factors which you need to look into before you really zero down on the particular company. By default, one is the sum assured, which you will figure it out how much you want to have as a family floater or individual policy. Also look at renewability, which means the policy needs to get renewed every year, come what may. And now there are companies which guarantees and assures you the renewability of policies that are going to happen. Also look at sublimits. Many companies now offer you facilities where there are actually no limit, and if I'm covered for, let's say, an X amount of money, I get paid at X amount of money. So there is no cutting in charges or deductions happening. So look at these features that really go a long way in actually helping you and ensuring you a kind of a stress-free period in case you need a claim going forward. So make sure that you take it as early as possible. Don't delay that. That's the point where our message I'm trying to give it to you.
Yeah, the couple of doubts that I had regarding taking a medical insurance. One is it a good idea to take a medical insurance for the four of us together in a floater, in the sense, because again, or separately for our parents and separately for the two of us? Because once we add our parents into the same policy, the premium shoots up, which probably is lower when we take it separately for them and separately for us.
Typically yes, because when you take a policy which is covered for all four of you, the oldest member of the policy, the premium is calculated based on that age.
Right.
So therefore the premium actually goes up. So if you exclude and take a separate policy for your parents and separately for you two, it actually will be more beneficial from a premium payment perspective. But do look at options and have various combinations. That what happens if I take a policy for all four of you together? What happens if I take for only you two? And then whatever sounds feasible and looks logical, go for that.
To get expert opinions on your finances, you can send us your queries at smartmoney@btvin.com. You can also call us on 022 4098 7098. You can also send us an SMS. Just type SM, give a space, write your query and send it to 977-327-0010.
Surya, as they have shared with us the fact that he's a freelancer, how do you now would recommend, and house being a very important goal for them, how do you see them achieving that goal in their lives?
See, typically they have already covered, we have discussed the health insurance part. You also need to look at from a life insurance perspective. They currently already have a term plan, but currently with the way the income structures are, it is not adequately covered. Currently Abhishek has around 3.5 times of his annual income as a cover, which typically you currently have of 50 lakhs. Thumb rule says 5 to 6 times you should be your targeted cover. So try to enhance that going forward. Also, when you go the family way, you need to evaluate your income replacement needs, which means in case God forbid something happens, then how much income your family would need to support them for the same lifestyle which they're having right now. A thumb rule is 6 to 8 times, but that may not be holding true when your family grows from here. So you need to evaluate how much cover you'll be needing and do that evaluation at every interval of 2 to 3 years, because life is going to get only expensive from here. So the replacement cost is very critical, and hence you need to evaluate that periodically. So that's on the insurance part. Coming to your other targets of your house. The moment you say house, my reaction, which I just controlled myself, I said, why you take a unit plan? And let me finish, sorry, before you say. You've taken the plan in the month of March.
Right.
And now you say, I want to get out. It's a matter of month and a half, if I'm not
Yes,
wrong.
yes, that's right.
And so that's what we advise everyone. It's your hard-earned money. And if you don't think before you buy, then there is actually no rational working so hard. You need to make sure you work hard, the money needs to work even more harder.
True.
If you can achieve that, half your problem is solved.
True.
So now the problem is, if you want to get out of that policy, my money gets forfeited. You're already out of the free look period. You yourself mentioned that. You're already out of the free look period. So if I want to surrender my policy, I don't get my premium which I paid in the first year, so which is not a small amount of money.
Exactly.
So for that one small error, I will lose that 1 lakh rupee. So my request to you would be, please understand what you buy, and if you don't understand, don't buy. But coming back to it, if I need to create a house, then this does not make logical sense for me. So before the next year PM comes out, you need to decide what you really want to do, whether I need to surrender and cut off my losses and create a corpus for 5 years down the line or 5 to 10 years in between when you plan to buy the house, because you rightly mentioned, I need money to pay for the down payment. How will I get that? So that money needs to come from the regular savings. So my request, please look at this, and your renewability of this plan will be dependent on what your plans are in the future. Further, you do have investments, you have a SIP running, please increase the amount. You have also mentioned and that you have already bought a couple of stocks as your portfolio. Now you want to further enhance and build a SIP book in the stocks.
Yes.
Okay? You want to have a X amount of money which you want to say, I want to save every month to build a stock portfolio.
Yes.
But do you have the time and the inclination to manage that portfolio? Can you do it yourself? Do you have the time and energy and the bandwidth to understand the stocks portfolio and regularly monitor that? Because that actually requires a lot of your man hours to be spent over there. The message over here is, prefer to buy through mutual funds, unless you really believe strongly that I can actually manage the stock portfolio. Otherwise, mutual funds in India are one of the cheapest and the most transparent and a process-driven way how you can actually invest. It's one of the cheapest countries where you can buy mutual funds worldwide. So please use that opportunity to create wealth for you for long term.
All right. So Surya, now let's move ahead in terms of any quick remedy measures, if you think that they can do to address as far as their portfolio is concerned, and quick to-do list. I mean, I'm not saying in terms of quick means to get money, so that's not what Smart Money talks about any time.
Sure.
But what is the course correction that they can do, number one, and what is the way forward, that what they need to do to help get their goal, which is to get their house?
Please save regularly, be disciplined in saving, increase your SIP book, we recommend it very strongly. Diversify your portfolio through the SIPs, because if you have a long-term horizon, which you do have for that house of yours, try to create equity as an asset class, which you already have. You already have a flavor through direct stocks. So you have that appetite and the capacity you already have. So please increase that, diversify within the equity asset class, and look at allocation between large caps, mid caps, small caps, add a hybrid fund. And please continue to increase your income savings from here as and when your income also increases. Do it for the next 5-6 years, and as you come closer to your goal of buying a house or likewise, you can gradually shift that money which you need to pay for the down payment towards more secured asset class. That's one of the simplest way how you can achieve difficult things in life. It's all about patience, building wealth over long term. There are no shortcuts over here. Once you are able to do that, I can assure you, you'll be able to achieve the targeted needs of yours.
Okay, now that Surya has given the mantra as to what you need to do, are there any questions? Are there any more concerns? You're very quiet. So is there something that's worrying you?
Okay, there are a couple of goals we have, right? Like, I think he's already written about house and retirement and kids and so on and so forth. So say we are saving X amount of money into SIPs over a period of time. So after 5 years, when I want to buy a house, is it better that I take out all the money from SIPs and then start again for my next goal? Or because then I'll be losing out that many number of years. So, I mean, I
got the point. You need to create various baskets for your savings. So let's say house is one basket for me. So the X amount of money needs to be invested for that basket, which is my house. Similarly, if you have likewise more baskets for your investments, for your various needs, which
Retirement, child. So create
that baskets and put that money into those baskets respectively. So each basket grow for their own horizon of investments. So as and when my one goal comes for maturity or the need actually arises, I can use that basket to provide for it. You can even do a reverse maths, that how much amount of money I'll be needing to achieve this goal of mine, and based on that just do a simple reverse math, that how much amount of money I need to save today to achieve that targeted amount. And when you do this maths, don't take it any exotic numbers. Be fair to yourself, be practical to yourself, and even the returns which you take, please make sure you target an expected return. Don't expect huge returns from the markets.
Right.
So be rational when you plan for it. If you are able to overachieve, it's all for you. But the target it is that you should not be underachieving that. So you have to be conservative reasonably when you plan for it.
for equity. Firstly, you have to have a very long-term horizon. The most important part.
Horizon of 5-7 years which you are planning to have. Take moderate return expectations. In equities, target anything from, let's say, 12%, 13% kind of returns.
So 12 is safe.
12 is a reasonable return to look at in the long-term picture. You may be able to overachieve it for sure, but then shouldn't be a targeted figure.
Right.
All right. Well, I hope we have addressed your queries with Surya really guiding you through that, and I hope wish you all the very best in terms of your entire financial plan, and wish you very best in your future, and hope in case you feel any more you have any more queries, you're always welcome to connect to us at Smart Money. So here was our conversation with Surya guiding the Chaudharys with regard to their financial plan. If you too want us to help you with your financial plan, please do write to us at Smart Money, and we will be more than happy to address your query and help you plan your finances better.
To get our expert opinions on your finances, you can send us your queries at smartmoney@btvin.com. You can also call us on 022 4098 7098. You can also send us an SMS. Just type SM, give a space, write your query and send it to 977 327 0010.